Stephen Wieting with us again with the market up 186 points with Citigroup Economics. Steve, good noon to you.
Oh, good noon.
Gigi mentioning the financials, the banks really not participating, but everybody else is. Is it another bang-up quarter for corporate profits? Do we know yet?
Well, it's a little bit early. We're less than 15% reported, and so it's a little early to really make it clear here. But we do think that this will be another quarter where overall results, at least, will be higher than consensus expectations. That's been 2 years in running. It probably will be narrowing down a little bit in terms of the breadth of companies that are growing earnings rapidly at this point.
And we got a Dow 14,000 chart. We showed this with Michael McKee. Wieting considers a sustained surge. The key word there, Stephen Wieting, sustained corporate profits. How far can they sustain into 11 and 12? When you make your economic models, do the corporations just keep doing it right into next year?
Well, bear in mind that during most economic expansions, earnings are rising faster than wages through most of the expansion until the downturns when actually wages outperform. This time around, though, there's a specific issue in that sense that we've had a lot of fiscal easing. We've actually, by some measures, subsidized the rise in the personal savings rate with a decline in national savings. We think that this has boosted profits in the economy first. There's demand in the economy while the wage bill is about $120 billion below where it was at the old peak. This very specific issue is going to mean that there'll be a time, I think, where the economy will grow faster than profits. But it's a slowdown in growth that we're looking at in terms of profits, not a drop immediately.
That's why we'd love to have you on. That's a break exclusive, Rex. That factoid there, $120 billion hole in wages. Where did those wages go? Are they there? Are they not there because of a lack of output, or are they not there because they went abroad?
Well, it's partly a timing issue. Wages are going up. And employment is going to follow demand higher, as it usually does. But there's been spending in the economy. Fiscal easing means whether you've created all the jobs that have been promised or not, that there's actually been spending in the economy with a new all-time high on consumption expenditures, with 7.5 million fewer people working. So we've created the demand first that boosts the profits. The wages should follow. But you have to keep in mind that it's taken larger budget deficits to do that in a way that isn't entirely sustainable, as we know.
Where are you on the budget deficit? With Lawrence Kotlikoff was just on with a lot of grimness. We're going back to the Weimar Republic. We're going to have Greek or Ireland kind of views. And a professor from Boston University could say that. Thanks to the emails here that came in on this, some people really upset at the professor. What's the Citigroup view on this deficit? I know you've got to be cautious, but you work for William Bowder, and he's an uncautious guy. So what's the Citigroup Bowder view?
Well, on the U.S., we think that sort of policy left on autopilot, we would, in fact, have our own fiscal crisis. You could just look at Medicare spending. Net Medicare outlays, net of the premiums paid, have risen 9% per 30 years. I think we could joke that, no fraudster has ever grown something twice as fast as the income stream that supports it for 30 years. So it's the issue really comes down to, will we, in the end, be able to align programs like that with the available resources, and it means terribly different policy changes in the future. I would say, though, this particularly after looking at the last couple of weeks, even before the S&P ratings announcement, there seemed to be more willingness, surprising amount of willingness, not cohesion in terms of what plans parties are agreeing on, but actually more action on addressing this front that we would have expected, certainly from a year ago.
Let's bring up too much information. Stephen, you can hold your finger up to your earplug like this, because we'd like you to hear. That's like you're at a political campaign and you're going, Chet, we're down here with a delegation from Kansas. Okay, too much information. The gift of low interest rates. This is a great chart from Steve Wieting. I went back 60 years, Steve Wieting, where we had a low interest rate interest outlays to GDP, and there's that pain of the late 80s and the 90s, and we've got low interest rates. Are we like Japan? Are we essentially Japan?
Well, I don't think that we are in a cyclical sense. We will come back on capital investment, on employment. We'll have ups and downs where Japan doesn't have those ups and downs. The sad fact is, though, that if we run large budget deficits in good times, you can crowd out private investment even at a low interest rate. There are different scenarios you can go through, but one of them is that the U.S. government would be able to borrow, but nobody else would. And you might find that on a trend basis that these budget deficits end up crowding out private wages. It discourages work. That on a trend basis, there is a certain resemblance to Japan, and that's one possible scenario if we go there.
What's the policy prescription? I mean, we had a commission, and it sounds like the president's rotating back to the commission. Would you agree with me on that?
Well, I'm not entirely sure about that, but certainly the idea that there has to be very broad-based shared pain, that some degree of sacrifice from every body in the economy is more likely to be a sustainable solution. If you saw S&P's warning, for example, that, okay, we may do something, but some future Congress could undo it. That's the kind of thing that we should be reasonably concerned about.
Note of the day. I'm going to put my finger up to my earplugs. Steve and I can bond here with our fingers here. Note of the day. Robert Zinch, U.S. dollar and debt ratings. We retain our concerns that dollar monetary policy will remain out of step with that, and most of the world leaving dollar and yen in an interest rate disadvantaged state. What does the weak dollar mean to you, Stephen Wieting?
Well, it's one of those things where it doesn't seem to drive nearly as much within the U.S. economy as outside the economy. A lot of policies in the United States would be entirely unchanged in a weak dollar environment or a strong dollar environment. And it's had some, but relatively modest impact on trade flows, on various measures like that. But it's something that we should be very concerned about in an environment where we enter into a fiscal crisis, which would be an entirely different scenario.
Very valuable. Thank you so much, Stephen Wieting.